Picture this. You open your bank app. Same login, same screen, same number staring back at you. Nothing changed. Not a single penny lost. And yet something feels off. Because the moment you step outside, when you actually try to use that money, it doesn't stretch the same way anymore. Groceries cost more. Rent quietly crept up. That weekend trip you took last year? Now it's out of reach. So you start doing that quiet calculation in your head. How is this possible? You didn't gamble. You didn't chase hype. You didn't make reckless bets. You did exactly what you were supposed to do. You saved. You stayed disciplined. You played it safe. And still somehow, you're falling behind. Pause for a second, because this is where most people stop thinking. They blame inflation like it's weather, random, uncontrollable, just something that happens. But if you zoom out, even a little, something uncomfortable starts to come into focus. Your money didn't disappear. It was redirected. Quietly. Systematically. Legally. No notification, no warning, no headline explaining it. Just a slow, almost invisible shift from your pocket to somewhere else. And here's the part most people miss. This isn't a flaw in the system. It is the system. What you're experiencing actually has a name. Not a popular one, not something you hear in everyday conversation. But once you see it, you can't unsee it. It's called financial repression. And it's been used before, very successfully. The real question is it happening again right now? So what exactly is financial repression? At first glance, it sounds technical, maybe even harmless. But the reality is much simpler, and a lot more unsettling. It's the process of keeping interest rates lower than inflation on purpose. That's it. Now think about what that actually means in real life. Let's say your savings account gives you 3% a year. Sounds reasonable, maybe even safe. But if the cost of living is rising at 6%, you're not gaining 3%. You're losing 3. Quietly. Every single year. And the key word here is real. Not what your balance says. Not what the bank shows you. But what your money can actually buy. This gap, that difference between interest and inflation, is where the transfer happens. And this is where things shift. Because this isn't just some unfortunate coincidence. It's not bad luck. It's not even poor policy in the traditional sense. It's a solution. See, governments today are sitting on levels of debt that are almost impossible to repay in the traditional way. Paying it back honestly would mean either raising taxes aggressively or slashing spending. Both politically painful, both economically risky. The other option? Default. Just admit you can't pay. But that breaks something deeper. Trust. Once a government defaults, investors don't forget. Borrowing becomes harder, more expensive, sometimes impossible. So they're stuck. They can't default. They can't afford high interest rates. And they definitely can't let borrowing costs spiral out of control. So what's left? They change the rules quietly. Instead of paying off the debt directly, they let inflation do the work. And at the same time, they keep interest rates suppressed, below that inflation level. Over time, the real value of the debt shrinks. It becomes easier to manage, easier to roll over, easier to live with. On paper, everything looks stable. But underneath, something else is happening. Because that missing value doesn't just vanish. It has to come from somewhere. And it comes from savers. From anyone holding cash. From anyone relying on fixed returns. From anyone who believes that playing it safe means staying protected. Think about that for a second. The system doesn't need to take your money outright. It just needs to make sure it grows slower than everything else. Slow enough that you don't panic. Quiet enough that you don't notice right away. And over time, that gap compounds. Year after year, the purchasing power drains. Not dramatically. Not in a way that triggers alarms. But steadily. Predictably. By design. And once you understand that mechanism, the next question becomes unavoidable. Has this ever been done before? Because if it has, and if it worked, then what we're seeing today might not be temporary at all. To understand what's happening today, you have to go back to a time when the world faced a similar problem, but on an even larger scale. The 1940s. World War II had just ended, and governments, especially the United States and the United Kingdom, were buried under massive debt. In some cases, debt to GDP ratios were well over 100%. For that era, it was unprecedented. The cost of war had been financed almost entirely through borrowing, and now the bill had come due. At first glance, the options looked familiar. Raise taxes? Politically explosive. Cut spending? Nearly impossible in a world trying to rebuild. Default? Unthinkable, especially after a war that was framed as a defense of stability and trust. So instead, they chose a quieter path. They turned to a coordinated strategy, one that didn't rely on headlines or dramatic policy shifts. It worked slowly, almost invisibly, but it was incredibly effective. They capped interest rates. Governments, alongside central banks, made sure that borrowing costs stayed artificially low. Not just low, but fixed. In the US, for example, long-term government bond yields were held down around 2 to 2.5% for years. This wasn't the market deciding. This was policy. At the same time, inflation was allowed, sometimes even encouraged, to run higher. Not hyperinflation. Nothing chaotic. Just enough. 3% for percent, sometimes more. Now pause and think about what that does over time. If you're earning 2% on your government bonds, but prices are rising at 4%, you're losing 2% in real terms every year. Not all at once. Not dramatically. But consistently. This is what's called a negative real interest rate. And during that period, it wasn't a one-year event. It lasted for over a decade. Let that sink in. More than 10 years where savers, especially conservative ones holding government bonds, were guaranteed to lose purchasing power. And they didn't have many alternatives. Because the system was structured that way. Banks were heavily regulated. Capital controls limited where money could go. Pension funds and institutions were often required, or strongly incentivized, to hold government debt. Moving money freely across borders wasn't easy. Access to alternative assets was limited for the average person. So people stayed. They held their bonds. They trusted the system. They believed they were being prudent. And slowly, year by year, their purchasing power eroded. But on the other side of that equation, something remarkable was happening. The debt was shrinking. Not in nominal terms. You still saw the same large numbers on paper. But relative to the size of the economy, it was falling. Inflation was lifting GDP, while the real burden of the debt was being chipped away. Quietly. Efficiently. By the early 1950s, debt-to-GDP ratios had dropped significantly. Not through austerity. Not through default. But through this slow, controlled transfer. And here's the uncomfortable truth. It worked. From a policy perspective, it was almost elegant. No panic. No collapse. No dramatic restructuring. Just time, inflation, and controlled interest rates. But it came at a cost. And that cost wasn't paid by governments. It was paid by savers. By people who believed that lending money to the government was the safest thing they could do. By retirees who relied on fixed income. By institutions that followed the rules. They weren't wiped out. That's what makes it so hard to see. They just fell behind. Year after year, a little bit at a time. And because it happened gradually, it never triggered the kind of outrage that a direct loss would have caused. No one got a bill. No one got a warning. But the transfer still happened. And this is the part that matters today. Because once you realize that this strategy was used before, and worked over an extended period, you start to look at the present differently. Not as a series of disconnected events, but as something that might be following a very familiar blueprint. Now here's where things start to feel uncomfortably familiar. Look at today's numbers. Across major economies, debt levels are back in territory that looks a lot like the 1940s, sometimes even higher. Governments borrowed heavily to get through financial crises, pandemics, stimulus cycles, and now, once again, the bill is sitting there. And just like before, the options haven't really changed. Raising taxes aggressively? Still politically dangerous. Cutting spending? Even harder now, with aging populations and social obligations expanding every year. Defaulting? That's still off the table for any major economy that wants to maintain global trust. So the same constraint remains. They can't let interest rates rise too high. Because here's the part most people overlook. When rates go up, the cost of servicing that massive debt goes up with it. And at today's scale, even a small increase in rates can translate into hundreds of billions in additional interest payments. Think about that for a second. If a government is carrying trillions in debt, moving from 2% to 5% interest isn't just a technical adjustment. It's a budget crisis waiting to happen. So what do? They manage it. Not always in obvious ways. Not always through direct control like in the 1940s. But through a web of policies, incentives, and regulations that quietly shape the outcome. For example, banks today are required to hold safe assets. And government bonds sit at the very top of that list. Pension funds, responsible for managing retirement money for millions of people, are often guided, sometimes required, to allocate heavily into those same bonds. On paper, it makes sense. Government debt is considered low risk, stable, reliable. But here's the catch. If inflation is running higher than the yield on those bonds, those institutions are locking in losses in real terms. And they're not doing it accidentally. They're doing it because the system is designed that way. This is what's different about the modern version of financial repression. It doesn't need strict capital controls or explicit rate caps. It works through structure, through regulation, through incentives that make certain choices seem prudent, even when they quietly guarantee underperformance. And it goes deeper than institutions. Because those pension funds, that's your retirement. Those banks, that's where your deposits sit. Those safe assets, that's what your money gets funneled into, whether you realize it or not. So even if you personally never buy a government bond, you're still exposed. Indirectly, systemically. Now add inflation back into the picture. Over the past few years, we've seen periods where inflation surged well above interest rates. And even when rates rise, they often lag behind. They move slower, more cautiously. Why? Because pushing them too high, too fast risks breaking something. Housing markets, credit markets, government budgets. So there's always this balancing act. Keep rates low enough to manage the debt, but not so low that inflation spirals out of control. And inside that gap is where the transfer happens. Again, quietly. This is the trap. It doesn't feel like a trap because nothing is being taken from you directly. Your account balance still shows a number. Your statements still look normal. There's no moment where everything disappears. But over time, the effect is the same. Your purchasing power erodes. Slowly enough that it feels like just the economy. Gradually enough that it doesn't trigger alarm. But consistently enough that, years later, you look back and realize something was taken. And here's the hardest part to accept. You didn't opt into this system. You were born into it. Your savings, your retirement, your financial safety, all of it is plugged into a structure that depends on this mechanism continuing to work. Because from the system's perspective, it's not a flaw. It's a feature, a way to deal with a problem that's too big to solve directly. Which brings us to the question most people eventually ask, usually a little too late. If this is how the system works, then who actually benefits from it? And more importantly, who doesn't? Once you see the mechanism, the divide becomes hard to ignore. Because financial repression doesn't hit everyone equally. It never has. There are clear winners, and there are very quiet losers. Start with the losers, because this is where most people unknowingly sit. If you're holding cash, you're exposed. It feels safe because the number doesn't move. There's no volatility, no sudden drops. But that stability is deceptive. If inflation is running higher than your interest, that safe position is slowly losing ground every single year. Then there are fixed income savers. People who rely on bonds, term deposits, or retirement products that promise predictable returns. On the surface, it looks responsible, conservative. But in a system where returns are capped and inflation isn't, predictability becomes a disadvantage. And this hits hardest for retirees. People who spent decades building savings, doing everything right, only to find that their money no longer carries the same weight it used to. Not because they made a mistake, but because the rules around them changed. Now flip to the other side. The winners. First, asset owners. People who hold things that can adjust with inflation. Real estate, equities, productive businesses. These aren't static. When prices rise, revenues can rise with them. Over time, the value of these assets tends to move with, or even ahead of, inflation. Then there are those with debt. This is the part that feels counterintuitive at first. If you owe money at a fixed rate, and inflation rises, the real value of what you owe actually shrinks. You're paying back that debt with cheaper money over time. So while savers are losing purchasing power, borrowers, in many cases, are benefiting. Think about that dynamic for a second. The system quietly rewards those who are leveraged into assets and penalizes those who stay in cash or fixed returns, which flips the traditional idea of playing it safe on its head. Because in this environment, safety isn't about avoiding risk. It's about avoiding erosion. And that leads to a much more practical question. If the system is structured this way, how do you adapt without overreacting? Not by making extreme moves, not by chasing trends, but by understanding where you're standing and adjusting carefully from there. So what do you actually do with this? Not panic, not swing to extremes, and definitely not try to outsmart the entire system overnight, because that usually ends worse. This is more about small, deliberate shifts. Start with awareness. Most people still think in nominal terms, what their account balance says. But what matters is the real return. After inflation, once you start looking at your money that way, certain things become harder to ignore. Next, take a closer look at long-term fixed income exposure. Not eliminate it entirely, but question how much of your future is tied to returns that can't adjust if inflation stays elevated. A slight reduction over time can make a meaningful difference. Then begin leaning gradually toward assets that have some ability to adapt. Productive businesses, broad equity exposure, tangible assets. Not because they're perfect, but because they're flexible. They can move with the environment instead of being locked in place. Liquidity still matters. You don't want to be forced into bad decisions because everything is tied up. But there's a difference between having accessible cash and letting too much sit idle while it quietly loses value. And this is important. This isn't about chasing returns. It's about reducing silent losses. Because once you understand the mechanism, the goal shifts. You're no longer trying to win the game in some dramatic way. You're just trying not to be the one consistently paying for it. And that brings us back to where we started. Same bank balance. Same numbers. Nothing obviously wrong. But a completely different reality underneath. The kind that doesn't announce itself. The kind you only notice once you know where to look.